welcome back. This is the second video for chapter 6, and it's a grab bag of other inventory topics. So in chapter 5, we looked at purchases and sales of inventory, plus some other topics. And in chapter 6, chapter 5, we looked at purchases and sales. Chapter 6, we looked at inventory costing methods. In other words, how to determine the cost of goods sold in the ending inventory. And we had those 3 methods: average cost, FIFO, and LIFO. Well, the rest of this chapter I've compiled into just other inventory topics that were listed in the chapter. So let's go ahead and move through them. The majority of the chapter, or the main part of the calculation, is in the first video, and these are other sort of knowledge topics. So let's remind ourselves that the reason why we study inventory so much, because it's an important part of running a business, but we also, in the business world, or at least in accounting, we list companies according to their usage of inventory. So it's probably helpful for us to kind of revisit that. So from the 3 types of companies, from the viewpoint of inventory. And the first type of company is a service company. Now, it's not to say that they don't have any inventory, because they may have some sort of inventory, but that's not how they generate most of their revenue. In other words, if you're a lawyer or an accountant or any, Netflix, you're not selling inventory, even though there might be some physical things you sell, but that's not your main business. So we would say that they are not an inventory type company. Merchandiser, which is what we study for the most part in Principles 1, is that they only have what we call finished goods. They buy things and they resell them without changing them. In other words, they buy something from a wholesaler, they don't change it, they just slap a sticker on it and put it on the shelf. This book also calls these merchandise goods, which that's fine. And then the last type of company is a manufacturer. Now, what they do is they take either component parts or actual raw materials and create something. So in other words, what comes in the door as inventory doesn't leave the same way. Merchandisers, they just buy and sell the product as is. Manufacturer actually do value add, they change it. So they've got more types of inventory. They have raw materials. If they haven't finished making something by the end of the accounting period, they have partially completed items, which we call work in process. And then they also have finished goods, which I'll just abbreviate FG. So 3 types of companies, and then we differentiate them based upon the types of inventory they have. We're focusing on merchandisers, and we'll continue with that. So the additional topics that we need to look at have to do with inventory. And so remember, part of what we looked at in the last video was how to determine ending inventory. And we used the accounting equation to do a lot of that. But one additional thing we need to look at is, well, how do we confirm what is in inventory, right? Before we can do all of those costing methods, we have to make sure what is in inventory. So confirm our inventory. And we've seen in a previous chapter where we said, okay, well, we may have a perpetual inventory kept on a computer, but we also go in, we physically count it. We call that a physical inventory. Now, and that's to make sure that what's in the computer is correct, and we can make a correction, but also to identify this is inventory that we physically own. But there are 2 ownership issues that we need to look at. The first one is we own inventory, but it's not physically in our warehouse, or it's not physically in our store. It's not physically there. Well, what is this situation? This situation is what we call goods in transit. And we're going to revisit an idea that we have used previously. Remember when we talked about FOB shipping point and FOB destination, we're going to revisit that with the idea of ownership. So previously we looked at that as far as who is paying the shipping cost, but we can also use the same sort of information to look at inventory ownership. So remember, an FOB shipping point, we had a seller and we had a buyer, and obviously the goods have to be shipped from one to the other. Well, we were concerned in the previous chapter on who pays the shipping cost. If we use the terms of trade FOB shipping point, well, the seller puts it on the carrier and it gets shipped to the buyer, but FOB shipping point means that the shipping costs were paid by the buyer. But we can use the same information to say, well, this dot here, when the seller relinquishes the goods to the carrier and the buyer is now paying for the shipping, this is also where we transfer ownership. So what we need to be careful about is not only is the buyer paying for the shipping cost, it actually owns the goods, even though it's not, it could be on the road. It could be in a container on a ship. It could be in a truck. In other words, it may be that the buyer has purchased it. They now legally own it, but it may not be inside the warehouse or inside the store. So when we do our physical inventory, it may not get counted. So FOB shipping point, we need to be careful. This means it's the buyer's inventory, even if it's not there. And similarly, we can use that same logic for FOB destination. So again, we have seller, and we have a buyer, and it's still on the boat or in the truck, but the transfer of ownership doesn't happen here with FOB until FOB destination. So previously we learned that in this case, the seller is paying for the shipping cost here, but you can also see the seller owns the goods, even though the goods have left the seller's warehouse. They're in a truck or they're on a boat somewhere, but they're still the seller's inventory. So when we want to confirm our inventory before we start doing all of our fancy costing methods, we need to, the seller under sales terms of FOB destination, this is still the seller's inventory, even though it's not physically present. So FOB shipping point, the buyer needs to be aware that that's their inventory, and under FOB destination, there's going to be inventory that's not there, but that is the seller's inventory. So we use the same terms and just extend it to not only cover the shipping costs, but also the ownership issues. So we said that there were two ownership issues. One is we own the inventory, but it's not physically there. You probably see where I'm going with this next, is that the inventory is physically there, but we don't own it. And this particular issue we call consignment. So I don't know about you, but when I was younger, my mom always took some old furniture that she called antiques, and I just called old. And she said, let's bring it to the consignment shop to sell it. Well, consignment shops are a place where the owner charge people a commission to put their furniture or whatever they're consigning on display. And when they sell, the owner of the consignment shop will take a little commission. But they don't actually own the inventory. They're just charging people for a chance to display their wares. That like my mom still owned that rocking chair that was on consignment, but it was not in our house. It was at the consignment shop. And from the consignment shop's point of view, the rocking chair wasn't their inventory, even though it physically was there. So now, consignment shops are very common, but maybe you haven't been to a consignment shop. So let's talk about a regular business. Have you ever gone to a grocery store and you go to the soft drink aisle and you notice that the people stocking the shelves in the soft drink aisle aren't actually the grocery store employees? It's all the vendor people. It's the people from Coca-Cola or whomever that are stocking, or the potato chip aisle is another one that That happens a lot. And what happens is sometimes is that high turnover goods like that, the grocery store has a working relationship with the vendor and says, we're not going to buy the inventory. What we'll do is we just want you to come by 3 times a week and restock the inventory. You'll manage the inventory. We'll give you shelf space. And what we'll do is every time we sell the bottle, we will take a commission and then pay you for the inventory after we sold it. And so all that soft drinks or all those potato chips are not actually, the grocery store hasn't purchased them yet. They only purchase them once they sell them. And so the vendors, the potato chip vendors or the soft drink vendors, are the ones that actually own all that inventory that's sitting on the shelf, and not the actual grocery store. And so this is a sort of thing that happens quite a bit in various types of businesses, some more than others, but it does happen a lot in the grocery store as well. So we have to have two different people involved here. We have the consignor. That's the person who owns the goods, but they are located someplace else. So this is a situation where we own the inventory, but it's not physically there. That's the consignor. That's like my mother, she owns the rocking chair, but it's at the consignment store. But the consignee is like the consignment shop, the person that owns the store. It's not their inventory. They're just charging the people a fee to display the goods. So they're holding goods that they don't own. And you'll see in the homework that there's a couple of different situations where they're trying to use the idea of consignment for whether or not we should include the inventory. We should include the physical inventory in our inventory count, or if we should exclude it. Okay, so we got a couple of other things. So like here we have 2 ownership issues. That's one topic. The 3 types of companies, that was another topic. Let's talk about, we got like 2 more topics. And this one is a little bit of an advanced topic, but I'm going to cover it, and that's the financial statement effects. In other words, of the financial statement effects of which costing method you use. So remember, we have, average cost or FIFO and LIFO. How does that affect our financial statements? So I'll just mention that this is an advanced topic. So when we come to the exam, this is going to be one of those A-level type questions. But remember that we have FIFO and LIFO affects COGS and affects ending inventory. Remember, that's what we're calculating. And this is an income statement item, and this is a balance sheet item. So depending upon which one we choose, it's going to have an effect on our financial statements. And what type of effect? Well, this goes to the heart of why LIFO, people choose LIFO. And so I'm going to focus on the primary case here. Now, I'll just point out that no other country allows LIFO, just the US. And so it's a sort of a weird topic. But essentially what happened is LIFO was introduced during inflationary times. And if you remember, LIFO starts off at the most recent item. So if you have inflationary for COGS, so if you have inflationary times, that means the COGS are going to be higher than normal. With COGS being higher, remember, net income is revenue minus expenses. COGS are expense. Revenue minus COGS equals net income. That means if the COGS are higher, your net income is going to be lower. And if your net income is going to be lower, their taxes are going to be lower. And the reason for this is during inflationary times, some companies argue that they don't want to be hit by 2 problems at once. The 2 problems are, first of all, during inflationary times, the cost, the wholesale prices are going up. That's a problem. But if they use normal FIFO method, the FIFO method would start off with the earlier cheaper prices, making their net income higher and therefore their taxes higher. So the argument for LIFO is that it matches the more current high-priced COGS to to inventory, thereby reducing net income and reducing COGS. So in other words, using LIFO, oh, here we go again. I didn't do it again. I'm never sure if it's recording or not, so I'll wait a moment. I see that. Oh, there we go. So again, we had it. I get at the 15-minute mark and I should be paying attention, and that's when it goes to sleep. Okay, we're still okay. Oh. Sometimes it autofocuses right away and sometimes it doesn't. There we go. Okay. And so I was saying that essentially LIFO was selected because it made life easier during inflationary times. So rather than having higher wholesale prices and higher taxes, LIFO gets rid of one of them. It reduces net income and reduces taxes. So let's take a little look at that and see. Let's take a very simplified version of that to see kind of what's going on. So let's say I have inventory to where I just have beginning inventory and I have one purchase. The beginning inventory was one item and it was $1. I bought a second item I purchased and it was $2. So you can see that's inflationary. It went from, doubled, went from $1 to $2. And if I only sell one item, so you can see this is a very simplified thing. Under FIFO, remember FIFO starts off with the oldest thing and moves forward. So if I only sell one item, well, this is going to be the item that I sell, the $1 item. Under LIFO, if I only sell one item, remember I start off with the most recent item and move forward. But if I just sell one, this is going to be my item that I sell. Well, if I sell this item, what's left in inventory? Well, this is my ending inventory and this is my ending inventory. So during inflationary times, right? This is inflationary because it's going from $1 to $2. During inflationary times, FIFO, you look at the difference. FIFO will have COGS of $1 and LIFO will have COGS of $2. So FIFO, the COGS will be lower, right? LIFO, the COGS will be higher. And if I look at this from a net income point of view, so if let's say my revenue was 10, right? Under FIFO, it would be 10 minus COGS of 1, therefore net income of 9. And under LIFO, the same thing would be revenue of 10 minus COGS of 2, or net income of 8. Well, you can see here the net income is going to be higher, right? Between these two, FIFO net income is going to be higher, and because the net income is higher, the taxes are higher. And under COGS, by adapting the LIFO method, because we're using the more expensive COGS, net income is going to be lower between the two, and therefore taxes will be lower. So I will just say that's what they're looking at, and that's what the homework question or the quiz question. And I will just mention that that's under inflationary. Deflationary is the opposite. And I will just refer you to the book, or you can figure this out for yourself by writing the same little thing with deflationary, where instead of beginning inventory being 1 and purchases being 2, it's reversed. Beginning inventory is 2 and purchases are 1, but it would be the opposite effect. And like I said, I don't want to spend too much time on this. This is an advanced topic. There's actually 2 advanced topics. The other one's an error in inventory accounting, but I'm not going to be requiring any homework on that, and I'm not requiring that for the test. But I do want this one in because I think it's important because it explains LIFO at least partially. Okay, the last topic in this group of other topics is what we call lower of cost or net realizable value, which we will abbreviate, thank you very much, NRV. And what this means is essentially it's a very simple topic, and it's based upon conservatism, meaning that accountants don't like to overstate anything if at all possible. So what we're basically saying as far as inventory is concerned, if the value of our inventory has increased over time, well, we can't mark anything up. We don't increase the value from the original price. Can't mark up. But let's take the reverse situation. Let's say you buy a bunch of iPhone 14s that you're going to sell, and then all of a sudden the iPhone 15 came out and you didn't realize it was coming out. Kind of an absurd situation. But now your iPhone 14s are probably worth nowhere near where you paid for them. You're probably going to have to sell them at a discount. So if you've got good information that your inventory now is worth a lot less for whatever reason, and you can think of, there's lots of things that inventory goes up and down pretty quickly. Think about gas prices. They go up faster than they go down, but they do come down as well. At least the market price of it. So we can't mark stuff up, but we must, if we have good information that the value is worth less, our inventory is worth less, we must mark down. And that's the essence of this. In other words, if we've got some items here where we have an original cost, and I'm not going to write out the word I could just write NRV. A lot of times we also say this as the market value. If I've got two products, product 1 and product 2, and let's say the total amount of value in product 1 originally was 600, but now it's worth more for whatever reason. The value has gone up. But I have a second product where I bought it for 500, but the current market price is down. Well, whenever we figure out the cost of our inventory, we have to decide which value are we going to use, the original cost or its market value. Well, just look at the name of this rule. We're going to select the lower of either cost or the NRV. So whichever one is lower is the one we're going to use. So for product 1, we're not going to mark it up. We're going to leave it at 600. But here, obviously, we have good evidence that product 2 has gone down in value. So we're going to use the lower of these. So in other words, my new total inventory cost, originally I bought it for $1,100, but now it's going to be $800 because I had to mark this one down. Okay, those are all the topics. I will be posting some information. This is the last chapter before the exam. The in-class people are taking an exam here pretty soon. I'm going to widen the exam window. I'm thinking about doing it this coming, say, Saturday, Sunday, Monday, Tuesday, or something like that. I will post in D2L some more information. Okay. The homework is open and is ready to be done as well. Okay, talk to you for chapter 7, or talk to you next time. I will talk to you. It'll be the exam prep video. Okay, see you soon.